Hello, everybody. Welcome to the show here. I'm here with Kareme Shorter with Fidelity Mortgage, and we're going to be talking a little bit about the process of the mortgage. This is something that's very important, especially in my business. I'm a real estate broker. I'm the owner of Kroll Realty Company in Fort Lauderdale, and Kareme shares office space next to our office, and he's very informative, and I've used him on a few deals, and he's very prompt, and he responds immediately when you need questions answered, which for me, that's one of the most important things in this business. So I'm going to ask him a few questions in the process of the mortgage. Good morning.
Good morning.
How are you?
I'm great, John. Thanks so much for having me. I really appreciate the opportunity. Obviously, it's a pleasure working with you, and I'm happy to speak with you.
Yeah. No, he's a very easy person to work with. Great. I can give him a lot of kudos and stuff like that, but if you get involved with them in the process, it really works out great. So basically, tell the public or the audience what the role of loan officer does and what's most important for him in the first meeting his client and getting the whole process started.
Mm-hmm. So I think of a loan officer kind of as like an official or a person that kind of officiates the entire process. So my role is to help a client go through the process of buying a home and not only work with that client, but work with all of the parties involved in that process. So that'll include the realtor, that'll include the underwriter or any lender that we choose to work with.
Yeah, that is so true because you got to know all the components. It's just like people don't realize. They think, oh, these guys we do fairly well when we sell a deal, but we have a long process to go through. And it's not that easy there's a lot of stuff that goes in the background. So what does the loan process we're just talking about take you through all the way to the approval portion of it?
Yeah, so typically I'll either meet with a borrower either over the phone or in person, or they may be referred to me from one of my referral partners or another realtor. And then I'll typically sit and discuss with them what their goals are, what their plans are in terms of purchasing a home, what type of home they're looking to purchase, typically where they're looking to purchase. And then I'll give them a brief overview of what the process is like. And then once we kind of outline what it is that they're looking for, the next step would be to fill out the necessary application that we'll have to send to the lender. And that's a process that I'll work out with them. So we'll typically need the basic information, their name, their address. I'll typically ask how long they've been working. And once we get that basic information, the next step would be to do a credit pull or a credit check. And the credit check is important because it'll list all of the things that a person will owe on their credit report. Which is also important because based off of those things, that has a pretty big effect on the amount that a person will qualify for in terms of purchase of a home. So once we go through that process, then that will segue into how much the person will be pre-approved for. And then once we get the pre-approval process or that person completed, then I'll typically relay that information to the realtor that we're working with, and then we'll go on the hunt for a home.
Yeah, that is a good point you brought up because people don't realize too that, I try to gear the borrower, I'm into play with this because to me, I've been doing this for 45 years and it's so important that things roll in a certain way because if you don't, it gets kind of convoluted and goes sideways.
Very true.
And you have to stay in contact with me, myself, I have to stay in contact with the mortgage broker. So, with that, and there's all different types of loans out there too. And that's one good thing. What loan fits you? What loan can you get into that's going to work best for you? They have adjustable, fixed, 5-year loans, with balloons, whatnot. Mm-hmm. There's a lot of different programs. So those are the time when you sit down with your mortgage broker like Kareme and give them all the information which you're looking for. And that's the first thing I ask. I'll relay a message to Kareme. I have a buyer I'm working with. Hey, Kareme, find out where Bob and Betty can work. I'm just using the name. Betty Sue. Yeah. Where can they fit? Because I don't want to waste my time as a realtor going out showing property and they get all excited and, John, they can't qualify for that. They got to be $100,000 less.
Yeah.
And that's frustrating. And it wastes my time. It wastes everybody's time.
It happens time
So
and time again.
the first meeting is important to get all those things done. Now, credit, what Kareme was talking about, credit does give an indication of where you're going to stand. And that does affect you because hopefully since Joe Biden and that administration going on, they've dropped it now where they give better ratings for people with low credit scores. I hope that doesn't go into effect. But if you do have a better score, Kareme, you can vouch for this, you get a better interest rate.
A better score? Yeah, typically the higher credit score you have, you're going to get a lot of benefits. A better interest rate typically is one of them. Better loan options, better loan terms is also another. You just get a lot more flexibility the stronger you look on paper as a potential borrower to any lender.
Talk a little bit about loan to value too. That's another thing because you got different types of loans. You got FHA, you got VA, you got conventional, non-conforming loans, all those there. But that plays loan to value means the value of what you put down and the value of the mortgage. Correct?
Correct. So I typically think of it as in the mortgage row, whenever I see loan to value, it's the amount of the loan you're getting in relation to the value of the home that you're purchasing. So for instance, I might see something that says, hey, this loan program that's available to potential borrowers has a loan to value of 80%. And what that means to me is that in order for a borrower to qualify for this program, they would have to put a down payment of 20%. So it's really important because, like John mentioned, there are so many different loan programs available, from ARMS to an FHA loan to a conventional loan, and all the different programs have different requirements and terms. And like you mentioned, the loan to value is one that's very important because obviously one of the bigger things that you're going to have to contend with is your down payment. So you're definitely going to work with a loan officer who's not only knowledgeable about the different loan programs, but what the loan to value means and what it's going to mean for you. And those things can be different depending on your credit score and some other variables as well. Yeah,
we're talking about the LTV, loan to value, and that in FHA basically, you can get in with the minimum of about 3.5%, and so your loan amount would be 90.5% of the total investment.
96.5.
So 96.5, correct. So, but people need to understand too, if you put 20% down, you get rid of MIP insurance because you will be carrying that MIP or private mortgage insurance. Kareme, you can explain a little bit about that.
Yeah, so depending on whether you go conventional or FHA, they'll have private mortgage insurance or your mortgage insurance premium. It pretty much has the same effect, and it's just to insure the lender just in the event that the borrower who borrowed the funds is no longer able to continue and pay against the loan that they've borrowed. So it's just as if, you were going to lend money to somebody and someone says, hey, listen, I know the money that you're lending to this person, they, may not meet certain requirements that would make you feel very comfortable in lending this money, but we're going to insure it in the event that, the person for whatever reason is no longer able to pay. And the government will do this to allow more people access to options to purchase a home. So it's the government's way of saying, hey, let's allow some people who in other situations may not have been able to purchase this home, particularly with say a 3.5% down payment. And instead of you having to save up, over a period of time or years, sometimes for a 5% or a 10% down payment, they'll say you can do, a minimum of 3.5%, but in order to do so, we want to ensure, the lender that's going to be giving you this money so that, everybody feels good about the transaction that's happening.
Yeah, and there's all kinds of terms too. When we went to school, I guess, when you go for his mortgage broker, you had all these little symbols. What's DTI?
DTI, so DTI will be your debt to income or your debt to income ratio. And that's one of the things that I'll look at and why it's important to look at the credit report, because all the things that you owe, your debts, are going to be on your credit report. And what I'll do is I'll look at your list of debts in relation to your income. So your debt to income, and there's a ratio there. And the way that they qualify borrowers is they'll say, okay, listen, if a borrower is at this particular ratio, this number, then they'll qualify. And if they're above it, then they may not qualify. So, and those ratios are different depending on the type of loan that you have. So, again, you want to work with, a seasoned or a knowledgeable loan officer that can kind of walk you through your debt to income ratio and where you're going to be with that, and how it's, how you want to, structure it so that it's best for you.
Yeah. Pros and cons too. There's terms of loan, 15-year, 20-year. I think they can go 40 years. I think there's some program. I heard that there's some programs where you can stretch it out.
Yeah. So with that, there was a change where if you have, and this is for people who have existing 30-year mortgages, they can amend it to a 40-year program.
Oh, okay.
So I've had some customers come and inquire about, hey, is there like a new 40-year? But it's for people who already have an existing 30-year mortgage, and then we can alter it into a 40-year. And change it that way. And you did mention 15-year terms. Obviously, a lot of people know about the 30-year term, but we also have interest-only mortgages. And, you run across a lot of, typically you hear about people who are just looking to purchase a home. But in this business, you run across a lot of people who are investors, who own multiple properties, use real estate for many different purposes. And that's why there's so many different loan programs available. So an interest-only program may work well for you. You may be somebody who is in a profession that expects to receive a large salary increase in the future, and there are loan programs tailored towards that. So, again, it's just really important to get with somebody like myself or with John, who's knowledgeable about these things and can really help tailor the loan towards you. Because I run into a lot of people who kind of know a little bit about loans per se, but don't realize that we're able to tailor it specifically towards you and your situation so that you can get the best outcome.
Yeah, that was very good. I mean, you did explain that correctly too, and people don't realize too that you're just talking about the interest-only loans, and your interest, your first 5 years is all interest. You don't even start hitting your principal until you're 6, 7, 8 years into the loan. So a lot of people doing those interest-only loans hey, we're only going to be here 5 years. Let's go with the lower interest rate. And that might be an option for somebody. And again, like Kareme said, you have to sit down and look at the long term as well, as a short term. Because people have different things that they're planning to do. And they're planning, maybe they're just here for the schooling for their kids, or kids are in their secondary, they're finishing up their high school, and then they want to move to a different area. Yeah. Or the kids are empty nesters. One child, they go away and they say, hey, we don't want to live here anymore. We want to live somewhere else. And they move out. But there's so many different things that you can talk to the client about that.
Oh, yeah.
So one big question here is important is what's going on with the housing market and what youth see and what's happening.
Yeah, I mean, there have been a ton of changes. Obviously, if you're a little bit familiar with it, you might have felt some of the changes nationwide with increases in interest rates. It affects so many things in terms of groceries and your day-to-day expenses, and also homes and how much you pay in interest for, the loan that you may have. But I'm sorry, what was the initial?
Yeah, the question was, and our economy with everything going on, and you're kind of like me sometimes. I get that little, thought, and I'm thinking,
I was going somewhere.
That's all right. You're human, though. You're not a robot.
Oh, yeah.
So what I was talking about is the economy. People are, and I'm kind of nervous about what's going on. Is our government going to crash? Is our economy going to crash? I mean, if they don't do something with the debt ceiling, it's going to really be a big ripple effect across the country. People won't be able to get their Social Security checks. That's a pretty heavy duty thing where people have paid all these years into the government, and now they're not going to be able to get a check to survive. A tough time. Yeah. So, and it does affect the interest rates. I know that most mortgage brokers will look at what the economist is going to come out and figure out what the I'm having your special moments now. The debts, where they base the interest rate on. I went brain dead. You know what I'm talking about?
Yeah, I do. Yeah. I listen to Jerome Powell anytime he'll come out and make an announcement in terms of if they're going to be increasing the interest rate.
The index, the common index. Okay. basically what they'll do is they'll base it off an index. That index is going to be based off, usually it's 2 points or 2.5 points above the index. That's what I was trying to get to, the point there. But so also another thing too that I'd like to ask you is what's common mistakes that people make? And I can tell you one. When I first started, I've been doing this for a long time. Don't buy anything when you're going through the process. I've had people buy trucks and they can't buy the mortgage because what happens is they repull the credit and they find out that their ratios don't work. And that's a tough situation when the wife can't get her new home and the guy gets his new truck and it's over.
See a lot of cold stares during that time.
Yeah.
Some of the things I've seen people do is, as a celebrationary measure, they'll say, man, I just got my house and, I'm expecting to close on Friday. I'm going to quit my job on Wednesday. And that tends to be a really big problem because, right before we close, everybody does a final check. They do a final check for your credit and your credit score, and they do a final check to make sure that you're still employed. So I've actually had a situation where we had to, work that out where the person left their job. I've had situations where the person will make very large purchases on credit. And as we mentioned earlier, with your debt to income, a purchase on credit will go on your listed debts. And we are going to check your credit right before the final closing process. So when they see that large transaction of 5, 10, 15, 20,000, sometimes if you are right on the cusp between being approved for the property that you're looking for or not, and you make that big purchase, it can push you over and then you might not be qualified. So, and that can be a pretty, as you can imagine, stressful situation to be in. So we always try to make sure nobody does anything like that. No big purchases, don't quit your job. If you have somebody that's also, going to be on the loan with you or a co-borrower, make sure that the same thing for them. But those are probably say to be the two biggest things. Keep your employment and no large purchases on credit specifically before you close. Yeah,
that does. Some of the spouses, one credit is better than the others, and they can't be on the loan, which it does affect things. So there is a pre and a post approval period in the loan process.
Oh, I did want to make a point because I know you asked me earlier in terms of what I see going on with the interest rates, especially in South Florida. And I'm sure you can attest to this, that I know years ago we used to have a lot more inventory. And I'm speaking to borrowers every day who are coming from California and New York and Texas and some of those cold weather or Midwestern states and are coming to Florida. So what it's done is it has reduced the available inventory in South Florida. And when you couple that with people who were already here and you have more people coming down, if you're a renter, what it means is your rent typically tends to increase. And if you can't afford that rent, then you might start looking for a mortgage. If you don't qualify for a mortgage, then you may have to move. And then everything, tends to become more expensive as you have buyers coming from different states. Many of them, not all of them, but many of them tend to pay cash or they'll pay the whole amount up front. And it tends to be enticing to a person who might be selling a property. So it creates this kind of situation where you have people who are existing here having a tough time with increasing rents and everything, just costing more in general, and then they may have to move, and then you're dealing with people who are coming from other states to Florida. It's kind of becoming a hotbed where, you're running into situations where if you're a realtor working with a client, you may have, you might put in an offer for a property and realize you have multiple offers, and then there's a lot more competition. And so sometimes that'll result in an increased price, or sometimes it may just result in your offer not being accepted for a property you might really want. So there's you change something in one sense, interest rates or increasing prices, and it really has a ripple effect in so many other areas, South Florida in particular.
Yeah, I weathered that storm. That was a pain in you know what. And it was very frustrating. You'd have to wait in line to get into an open house when a listing would come on, and the street would be filled with cars. I've never seen that in my life. And
looking around.
Only way you had to coach your people is say, hey, you're gonna have to pay probably 10 or 20% higher than what the price is just to get into the deal. So those were hard things to swallow for me, because I don't like people paying over price if they don't have to. But it It is an interesting business. It comes and goes. It's like the tide, the high interest rate, the high tide, low tide. So those are things that do affect, and it's important when you have knowledge and people that take pride in what they're doing, which I can see that in Kareme because he does research, he does pull up things, and if he has a situation, we had a deal, and he did research it, and we were able to find a lender that offered a down payment assistant, which kind of affected the whole situation of the deal. And this is a real life deal that we were working on, and still are. But it just was. It was something that I thought that was pretty impressive when he came back and said, "Hey, I found a lender that can handle this file."
Yeah, I know we spoke about different loan types earlier, and then we also spoke about how the environment with South Florida in particular is, and what I've noticed a lot of lenders doing now is, just like we'll look and say, hey, what are the pain points or what are the issues that our clients are having, and how can we best address those issues? And with a couple lenders I've seen now is the biggest thing a client or a borrower will have to work towards is their down payment. Mm-hmm. So what I've found a lot of them doing now is they're financing your down payment. Mm-hmm. And sometimes even if it's 3.5%, and it's going to depend on the value of your home, but that can work out to be thousands of dollars. Mm-hmm. So instead of you having to take that money and put it as a down payment, and another thing, a lot of people, or many people believe that, okay, all I need to do is save up my down payment and I'm good to buy a home. And they don't realize that there are additional closing costs associated to the purchase. So, but with the 100% financing program, they'll finance your down payment. So the 3.5% that you would have saved and had to use just towards your down payment will be financed. So instead of having to spend that money towards the down payment, that can be used towards your closing costs, or that can be used towards purchasing furniture or any repairs to the property, or just helping to help facilitate the deal so that it's more favorable towards you. Or we also use it to purchase points so that your interest rate is lower. And again, this just speaks to being able to tailor your loan towards you so that it works best towards your immediate goals or what it is that you're trying to accomplish.
Yeah, people don't realize too when you have to build in maybe a higher interest rate that you're paying. That interest, you can still write that off on your tax returns. From what I gather, I know there's a certain percentage. You got to talk to your accountant about that. But there's so much benefits to owning than to rent. And people just don't. They just get hung up in that situation. I guess they're scared in a way. They don't want to own a property with all the expenses and other things that come along with that. But there's so many positives that outweigh the negatives that are way far better than renting.
Oh, so many. I mean, obviously with the pandemic and everyone being at home, we saw similar situation where there are a lot of people coming from different states, but we also saw a big increase in the value of those homes. And one of the things that I like about owning property is being able to access the equity in the property. And when you're renting, that's not really an option that you're going to have. So I love owning in terms of real estate. I encourage, majority of the clients that I work with to do the same. And then I also educate them on the opportunities that they have by owning, because as you're paying that mortgage and as the value of your property increases, there's value in that home. And depending on where you are in life, or depending on what it is that you're trying to do, some people use the money to pay off their student loan debt or their credit card debt, or some also use it to go on vacation. But you have a lot more flexibility and options, and we know as we go through life, things tend to happen, and sometimes those things that happen you can't necessarily plan for or foresee. And so it's always good to have an egg or a cushion or a means of accessing money if and when you need to, and at times at more favorable terms than going to your traditional bank.
True. We have so many different topics we can cover, but I guess we'll kind of end with this topic here is that we did talk about that, and that was a point you just brought up. A lot of people have reoccurring interest on loans and stuff that they want to get rid of student loans, like you said. Now, if you own a property and you have equity in that property, you can do an equity line to pay that off. You might not, I don't know the parameters on regards to writing that interest off on the loan payments or not, with the student loans or not, if the government allows that. But I do know that on the interest, you do have that. So that might be a benefit for you to consolidate it down into one mortgage and then cover all these debts and make it a lot more easier and simple for you. And in the long run, that'll build up your credit score too as well.
Yeah, I've done refinances for clients, and I know typically people would think of a refinance as, okay, I have a particularly higher rate and I'm going to refinance it into a lower one. But we do refinances where, like you mentioned, a client will get a line of credit using their home as collateral. Or we do cash out refinances where you'll get a lump sum of cash. And it's beneficial just because, obviously we all need cash for different purposes, but depending on where you are in life or what you may need to pay off, some people have medical issues. Student loan debt is a huge one.
Right.
You can use it for that purpose.
Yeah, and there is, the reverse mortgage is a big thing out there now. A lot of people. We had a speaker we had an event here at the office yesterday, and there was a gentleman that does reverse mortgages. And he enlightened me on a lot of things with that, because I try to steer people away from that. But it does serve a niche. It does help people in a certain situation, and it keeps people in their homes, and they don't have to worry about that debt. But again, also to point out one thing. Usually, what I tell people that let's just say you have 9% interest rate and the rates drop down to 7%. I usually use that 2% margin to make sense to make a refinance on it, to drop it down. Again, you might not be in a situation you need that money and you need to pull that equity out. So you might, take it at a 1%, but usually the margin to be at a safe point is 2% on the difference between. But again, thank you for taking the time to explain the mortgage process and the different hurdles and the things that you have to go through in the process of getting a mortgage. So I guess we'll end on that. If you wanted any key things you needed to contact Kareme, you'll see in the end of this podcast that he'll have his information, his contact information, as well as mine, to get in touch with us. And feel free to contact us. So we, right here, centrally located in Broward County, right on Federal Highway, right near Commercial Boulevard. We're very friendly here. If you want to come in and talk about, so there's no strings attached. There's nothing that's going to bind you to doing sign something with us, an agreement that you have to use us.
No,
but stop in. We're here to help, and that's the beauty about this business, because you develop relationships and you get referral business. And my business is mostly referral business over the years, so it does benefit when you take care of the customer. And sometimes things don't work out the way you would think they would, but that's just the process of buying and owning property and going through the whole process. It does. You do have sometimes hurdles that you go through, but we try to navigate through them and not foresee those and avoid those things that would affect the bad outcome.
I can attest to it by working with you that John does an excellent job at foreseeing potential issues. And I've worked with a few different realtors throughout my career here, and I can 100% say that you are a realtor that cares for your clients from the most that I've seen.
Yeah.
And they really appreciate it.
Yeah, no, it does. You got to figure that's the biggest investment some people are making, and they've worked hard and saved their money to buy something, and you don't want things to go sideways on them. And I try to do the best I can. Sometimes we have to dip in our pocket and help out, to get the deal closed. And I don't mind doing that. I don't like to, have to fork up the money, but it is, if it's going to work out in the long run, so be it. Let's get it done.
I hear you. No, definitely a pleasure. I can sit and talk to you for hours.
I'll charge you for that.
Oh.
All right. Thanks, Kareme. I appreciate your time.
Thank you, John. Thanks for having me.